Okay. Let's continue. Can you hear? Class, can you hear?
Yes, ma'am.
Yes, ma'am.
Clear na? Clear na, hindi?
Clear na,
Clear na,
ma'am.
ma'am.
O, sige. So, let's continue now with the cornerstone exercise. Actually, iyan na ni sang 2-2. So, we have now the 3 groups of customers with the corresponding total cost per case. Now, in requirement number 2, we are going to determine the profit percent per case. First, we have to consider the price per case as given in the problem, and then we deduct the cost per case computed in requirement number 1. We end up with the profit per case. Divide the profit per case by the price per case, so you get the profit percent per case. The profit percentages range from 0.2% to 6.41%. There appears to be cost justification for the price differentials among the 3 customer classes, although the small grocers could be charged a higher price, no? So the small grocers could be charged a higher price that would be based on the cost incurred. So, but then actually the small grocers are charged with the highest price, but the profit percent is still the lowest. Now, in the case number 3, in 2-2, what if Kauni charged the average price per case to all customer classes? How would that affect the profit percentages? So, if you have now to determine the average price per case is computed at 79.67. If you add the price per case, we add 58, 93, and 88, and the total we divide by 3. So that gives us the average price per case of 79.67. If this price were charged to all 3 customers, the profit percentage for the supermarkets would increase, and the profit percentages to the small grocers and convenience store, okay? Or we have now the convenience stores would decrease, while Kauni would earn the same overall profit percentages. This assumes that the supermarkets would continue to purchase canned nuts from Kauni at the new higher price. So, balima 79.67 amo na ang ibayad ni supermarkets. However, if there are good alternative sources for the nuts, the supermarkets might well refuse to buy any product from Kauni, and that will leave Kauni with fewer units sold overall and a lower profit from the remaining customers. Now, that gives us the solution for problem number 2. Next, we go to exercises 3 and 4 are uh, related to only one problem. Only that number 3 requires the use of absorption costing. Number 4, using variable costing. Now again, if you can recall, in chapter 10 of Vanderbeek, we have already taken up absorption costing and variable costing. So meaning here, it's merely a repetition. Now for the case of absorption costing, first, we have to determine the unit product cost. The unit product cost includes direct materials, direct labor, variable overhead, and fixed overhead. So that will give us the total cost. Now, what is very important in the case of absorption costing is that we include here the fixed overhead. So the units in the ending inventory, we have beginning of 0, then we have production of 40,000 units, and given in the problem, sales of 38,400 units. So the units in the ending inventory is 1,600. So the cost of the ending inventory is 1,600 units times 1650. That gives us 26,400. Now, for the next requirement, we have the income statement for the month of October. That's by using absorption costing. So, we have now the sales minus the cost of goods sold, again using absorption costing at 1650. So, bali, nadala na dira ang fixed overhead. So, we now get the gross profit kay absorption costing. Then, we deduct the variable marketing expense and the fixed marketing and administrative expense, giving us the operating income of 111,420. That's for the month of October by using absorption costing. Then number 4, we have to determine the units in the ending inventory for the month of November. On November 1, the beginning inventory is 1,600 units. Then we are adding production of 40,000 units again. Then we deduct the units sold of 41,000. That will now give us the gross profit. Again, we are using absorption costing. And from the gross profit, we deduct variable marketing expense and fixed marketing and administrative expenses. So, leaving the operating income of 127,800. That is by using absorption costing. So, we have now the operating income for October and for November. In exercise number 4, we are going to determine the unit product cost by using variable costing. So, variable costing, we begin with direct materials, direct labor, and variable overhead. Here, we exclude the fixed overhead because we are using variable costing, and the fixed overhead will be treated as period cost. So we have now the cost per unit of only 9.50. Then the units in the ending inventory, we have the units beginning inventory plus the units produced minus the units sold. We have now the number of units in the beginning inventory is 0. Produced 40,000 and units sold 38,400. So we have 1,600 units in the ending inventory. By the way, this time we are using variable costing. So the cost of the ending inventory is only at 9.50. So, for the income statement for the month of October, we have now your sales. Then we deduct the variable cost of goods sold and the variable marketing expense. So, we have the difference as the contribution margin. So, we have now the contribution margin minus the fixed factory overhead and the fixed marketing and administrative expense. So, I have mentioned earlier that in variable costing, the fixed factory overhead is not included in your cost of goods sold, but it's treated as a period cost. together with marketing and administrative expenses which are fixed. So we have now the operating income equal to 100,220. That's for the month of October. Now, if you will compare this with the operating income under absorption costing for the month of October when production exceeds sales, your production of 40,000 units and sales of 38,400. That's for the month of October. So if production exceeds sales, our net income under absorption costing is higher than that under variable costing. Now, let's try to go back to the income statement under absorption costing, where we have the operating income, ARA. For the month of October, the operating income is 111,420, and that is absorption costing. In the case of variable costing, our operating income is 100,220. So our guideline states that if production exceeds sales, the income under absorption costing is higher than that under variable costing. So gani dito sa absorption costing, we have income of around 111,000. Here we have only 100,000. That is if production exceeds sales. Now in the case of the last case, if sales exceeds production, in the case of number 4, the units in the ending inventory ini by November na. Beginning inventory November 1, 1,600 units, and then we add 40,000 units produced, and we deduct 41,000 units sold. So we have 600 units in the ending inventory by November. So the cost of the ending inventory is at 9.50 times 600. So it's only 5,700. And the operating income by using variable costing is 134,800. So again, our guideline is if sales exceeds production, that is in November, when sales totaled 41,000 while production only 40,000. So if sales exceeds production, our net income under variable costing is higher than that under absorption costing. And that applies to the month of November. Our operating income is 134,800 under variable costing, 134,800 under variable costing, whereas under absorption costing, our operating income amounts only to 127,800. That is for the month of November. So again, if sales exceeds production, the income under variable costing is higher than that under absorption costing. Ang sa absorption, only 127,800, whereas in variable costing, we have a higher net income or operating income, and that is for 134,800. Next, we go to number 5. We have for number 5, sales price variance, sales volume variance, overall sales variance. Now here, actually in the PowerPoint presentation, we were given the formula for all this, variances. For the sales price variance, we have the formula for the actual price minus the expected price, and we have to multiply that by the quantity sold. And by the way, when we talk about the expected price, we are also referring to this as the budgeted price. So, expected price or budgeted price. So, the formula now, we apply the formula for determining the sales price variance. Actual price 520, the budgeted price of 530, and you multiply by the actual quantity sold. So, we now get 0.10 multiplied by 30,600, we get an unfavorable sales price variance equal to 3,060, and it is unfavorable. Second, we have the sales volume variance. So the formula is actual volume minus expected volume, and you multiply by the expected price. So the actual volume, you have 30,600. The expected volume or the budgeted volume is 30,000, and you multiply by the expected price of 530. That gives us a favorable variance equal to 3,180. Now, for the overall sales variance taken by just adding the sales price variance and the sales volume variance. If the sales price variance is unfavorable of 3,060 and the sales volume variance is favorable of 3,180, we have the favorable overall sales variance of 120 is favorable because the sales volume variance is higher than the sales price variance. The overall sales variance favorable because the favorable sales volume variance is larger than the unfavorable sales price variance. That is, the lower than expected sales price did decrease revenue. However, the higher than expected volume overcame the effect and increased revenue overall. Now, requirement number 4, what if December sales were actually 29,800 bags? So, this is instead of 30,600 bags. How would that affect the sales price variance, sales volume variance, the overall sales variance? So, what if instead of the actual bag sold of 30,600 this time, you have only 29,800? So there would be a decrease in the sales price variance since the actual number of pounds sold decreased. There would be an unfavorable sales volume variance, and the overall sales variance would be unfavorable because both the sales price variance and the volume variances are unfavorable. So that's now for requirement number 4 of exercise 5. Now we go to the next problem, contribution margin variance. Now the company produces and sells two types of countertop ovens, the toaster oven and the convection oven. Now we are given the budgeted amounts and the actual amounts. By the way, again, budgeted would refer to the expected amounts, and of course, we have the actual amounts. So in requirement number 1, calculate the contribution margin variance. We have the actual contribution margin given at 3,226,600. That's the actual contribution margin. Then we deduct the expected or the budgeted contribution margin. So this gives us the difference of 23,400 is unfavorable because the expected contribution margin exceeds the actual. Then in number 2, what if actual units sold of the convection oven decrease? How would that affect the contribution margin variance? What if actual units sold of the conversion oven increase? How would that affect the contribution margin variance? If units sold of the convection oven decrease while everything else remain constant or remain the same, the contribution margin variance would increase. On the other hand, if units sold of the convection oven increase while everything else stays the same, the contribution margin variance would become smaller. Whether it turned favorable would depend on the amount of increase in convection oven. That's an answer to number 2. Now, 2-7 and 2-8 still relate to 2-6. So, we have 2-7 required calculate the budgeted average unit contribution margin. So, the budgeted average unit contribution margin is taken by dividing 3,250,000. That's the total budgeted amounts of overhead. So we have to divide this by the budgeted production of 25,000 and 15,000 ovens. So we get the average unit contribution margin of 81.25. Now, for the contribution margin volume variance, we now have the actual quantity sold. So, what is the actual quantity sold? And we have now 25,800. Now, it's given in your actual amounts. For toaster oven, you have 25,800. And for convection oven, it's the amount of 14,000. So, the actual quantity sold minus the budgeted quantity times the budgeted average unit contribution margin. Actual quantity sold, we are adding 25,800 actual plus 14,000 for the actual quantity sold. The budgeted quantity sold is at a total of 40,000. Now you take the result of multiplying 40,000 by you have your budgeted quantity sold mo ng 40,000 and you compare this with the actual quantity sold. So, ang actual is 39,800 lang. Ang budgeted is 40,000. So, we now compare the two and get the actual quantity sold. 25,800 plus 14,000 minus 25,000 and 15,000 and multiplied by 81.25, giving us the unfavorable contribution margin volume variance. Now we go to requirement for number 7. Number 3, what if actual units sold of the conversion oven decrease? How would that affect the contribution margin volume variance? What if actual units sold of the convection oven increase? How would that affect the contribution margin volume variance? So, if actual units sold of the convection oven decrease while everything else stayed the same, the contribution margin volume variance would decrease and become even more unfavorable. Now, anyway, you have here the comparison of the budgeted and you have the actual amounts. Okay, so if actual units sold at the convection oven increase while everything else stays the same, the contribution margin volume variance would become less unfavorable. Okay, whether or not it would become favorable would depend on the amount of the increase in convection or oven sales. Now we go to 2-8 sales mix variance. Refer to exercise 2-6. Calculate the sales mix variance. What if actual units sold of the toaster oven increase? How would that affect the sales mix variance? What if actual units sold at the convection oven increase? How would that affect the sales mix variance? Since we are already computing for the sales mix variance in number 8. So for the sales mix variance, our formula is product 1 actual units minus product 1 budgeted units. So product 1 toaster oven actual units equals 25,800. The budgeted number of units is 25,000. Then we multiply the difference by product 1 budgeted contribution margin. So we have now product 1 budgeted contribution margin minus the budgeted average unit contribution margin. That's for product 1. So we now have 25,800. Amo ng actual units sold. Ang budget, 25,000. Then we multiply the whole thing by the difference between 70 per unit. 70 per unit taken by dividing 1,750,000 divided by 25,000 budgeted units. So, the sum of the toaster oven, the difference is the contribution margin of 1,750,000. Then we divide that by 25,000 units. That's your budget. We get 70 per unit. Now, that's 70 per unit. Okay, requirement number 3. What if we have, requirement number 3. What if actual units sold, no? We have a requirement number 1, the sales mix variance. The actual units, product 1, 25,800. The budgeted units, product 1, 25,000. Then you multiply this by the budgeted contribution margin and the budgeted average unit contribution margin. So we have 70 taken by dividing 1,750,000 by 25,000 budgeted units. So we now get 70 per unit. And 1,500, that's for product 2, divided by 15,000 units or 100 per unit. So 25,800, the number of units that's considered to be actual, minus 25,000 nga budgeted. Then you multiply by 70, that's product 1 budgeted contribution margin minus the budgeted average unit contribution margin, which we have computed above. Then we add to 14,000. 14,000 is your product to actual units, and the budgeted units is 15,000. We multiply this by product to budgeted contribution margin, product to budgeted contribution margin minus the budgeted average unit contribution margin. So for product 2, we have 14,000 minus 15,000 times the difference between $100 and 81.25. Now shown in the computations. Okay, so that's now for requirement number 1. In requirement number 2, what if actual units sold of the toaster oven increase? How would that affect the sales mix variance? What if actual units sold of the convection oven increased? How would that affect the sales mix variance? Okay, so in requirement number 2, if actual units sold at the toaster oven, the low contribution margin product, which is only at 70, if the actual units sold increased while everything else stays the same, the sales mix variance would become increasingly unfavorable. If, on the other hand, actual units sold, okay, of the convection oven increase, all else equal, then the sales mix variance would become more favorable. So this time we have requirement number 2 of 2-8. Now we go to 2-9, another problem that will give us the market share variance and the market size variance. So the market share variance and the market price variance for exercise number 9. For exercise number 9. Now, let's try to determine the market share variance for number 9. Okay, how do we determine the market share variance and the market 18-9? We have 2-9. Calculate the market share variance. Take percentage out to 4 significant digits. So the market share variance is computed by deducting from actual market share percentage the budgeted or the expected market share percentage multiplied by the actual industry sales in units times the budgeted average unit contribution margin. So we now have the actual market share percentage taken by dividing 39,800 here for the given number of ovens. So we have 39 sales in units, 15,000 plus 14,000. Amo ni ang actual sales in units sang aton nga convection oven. Ang iya gali nga sales in units 25,000 nga budgeted sang toaster oven. Sang convection oven 15,000. Sa actual, ang oven toaster 25,800, ang convection oven 14,000. So for the market share variance, the actual market share percentage is 39,800. It's taken by adding the actual sales of both toaster and convection oven. So 39,800, and we divide this by the total of 2,550,000 unit sales for the industry, sa whole ng industry. So the market share percentage for our company is 1.56%, while the budgeted market share percentage is taken by dividing 40,000, that's the budgeted sales, and we divide this by 2,500,000 being your total number of uh, oven toasters sold for the entire countertop top oven industry. Amo ni ang budgeted. Ang actual is 2,550,000. So the budgeted market share percentage is equal to 1.6%. Ang actual market share percentage is 1.56%. So the market share variance is the difference, and we have now the formula. Actual market share percentage of 1.56% and the budgeted market share percentage of 1.6%, and you multiply this by the actual industry sales in units. So the actual industry sales in units, and multiply by the budgeted average unit contribution margin of 81.25. Okay, so we have now 82,875. It's unfavorable market share variance because the actual share of the market is only 1.56%, while the budgeted is 1.6%. Now, calculate the market size variance. Actual industry sales in units minus the budgeted industry sales in units. We multiply by the budgeted market share percentage times the budgeted average unit contribution margin. So the actual industry sales of 2,550,000 units minus the budgeted of 2,500,000, and you multiply that by the market share percentage budgeted of 0.16 times the budgeted average unit contribution margin given at 81.25. So we have a favorable market size variance because the actual units sold exceeded the number of units budgeted or expected to be sold in the market. Now, what if Elif actually sold a total of 41,000 units